Imagine this. You're scrolling through your portfolio, looking for that one stock or ETF that can give you a real edge. Something with the power to generate income, serious income, without forcing you to give up on growth or take on wild risks. What if I told you there's an ETF out there with a yield over 12%? Today, we're diving deep into SPYI, the NEOS S&P 500 high-income ETF, and comparing it to the rest of the high-income ETF universe. Disclaimer: the content provided on Bearish to Bullish is for educational and informational purposes only. Nothing in this video or on this channel constitutes personalized financial, investment, or tax advice. All investing involves risk, including the possible loss of principal. Past performance is not indicative of future results. Before making any financial decisions, you should consult with a qualified financial advisor, accountant, or other professional to discuss your individual circumstances. Is this the holy grail for income investors, or is there more to the story? Stick around because we're about to break it all down. You've probably heard people say, if it sounds too good to be true, it probably is. But what if this time it isn't? What if a 12% yield is not only possible, but sustainable? Let's find out. Let me take you back to last year. I was sitting at my desk, coffee in hand, reviewing my Dividend ETF holdings, VYM, SCHD, SPYD, all solid, all reliable. But the yields, 3%, 4%, maybe 4.5% if I squint. Then, in a late-night research rabbit hole, I stumbled onto SPYI, a 12% yield, monthly payouts, exposure to the S&P 500. My first thought, what's the catch? What is SPYI? So what exactly is SPYI? The NEOS S&P 500 high-income ETF ticker, SPYI, is a unique fund that combines the stability of S&P 500 stocks with a sophisticated option strategy to generate high income. Unlike traditional S&P 500 ETFs like SPY or VOOO, which rely solely on dividends from their holdings, typically yielding 1 to 2%, SPYI takes things to the next level. It invests in a portfolio that mirrors the S&P 500. Think giants like Apple, Microsoft, and Amazon, but overlays a call spread option strategy. This involves selling call options on the S&P 500 index and using the premiums to boost the fund's income. The result? A trailing 12-month yield of approximately 12.2%, paid out monthly, making it a dream for income-focused investors. As of today, SPYI manages over $4 billion in assets, with an expense ratio of 0.68%, which is reasonable for an actively managed fund with such a complex strategy. For context, that's higher than a passive ETF like VOO, 0.03%, but competitive with other options-based ETFs like JEPI, 0.35%. SPYI's combination of high yield and S&P 500 exposure makes it stand out, but its option strategy is what sets it apart from the pack. The competition. To understand SPYI's place in the market, let's see how it stacks up against other popular income-focused ETFs. Here's a side-by-side comparison of SPYI and its peers based on their yields and strategies. SPYI's 12.2% yield towers over traditional dividend ETFs like VYM, Vanguard High Dividend Yield ETF, 3.1%, and SCHD, Schwab US Dividend Equity ETF, 3.5%, which focus on high dividend or dividend growth stocks. Even SPYD, which targets the highest dividend stocks in the S&P 500, only offers a 4.5% yield. Among options-based ETFs, JEPI, JP Morgan Equity Premium Income ETF, comes closer with a 7.7% yield, using a similar covered call strategy, but with a different stock selection process. For a non-equity comparison, HYG iShares iBoxx High Yield Corporate Bond ETF yields 6.3%, but it's focused on bonds which carry different risks, like interest rate sensitivity. SPYI's yield is unmatched in this group, making it a standout for investors prioritizing income. However, its unique strategy means it's not a direct substitute for these other ETFs. So let's explore how it achieves that yield. The secret sauce. The magic behind SPYI's sky-high yield lies in its call spread options strategy. Unlike traditional ETFs that rely solely on stock dividends, SPYI generates income in two ways: the dividends from its S&P 500 holdings and the premiums from selling call spreads on the S&P 500 index. A call spread involves selling call options, which give buyers the right to purchase the index at a set price, while simultaneously buying other call options to limit risk. These premiums are collected regularly, boosting the fund's income, especially in volatile or flat markets where options prices are higher. For example, if the S&P 500 is trading at 5,000, SPYI might sell calls at 5,100 and buy calls at 5,200, pocketing the premium difference. This strategy thrives in choppy or sideways markets, where the S&P 500 doesn't make huge upward moves. The result is a consistent stream of cash that funds SPYI's 12.2% yield, paid out monthly to shareholders. This approach allows SPYI to deliver income far beyond what traditional dividend ETFs can offer, making it a powerful tool for income seekers. The trade-offs. No investment is perfect. SPYI high yield comes with trade-offs. First, the call spread strategy caps upside potential. When you sell call options, you're agreeing to sell the underlying stocks or index at a predetermined price. If the S&P 500 surges, say a 20% rally in a year, SPYI won't capture the full upside because its gains are limited by the sold calls. For example, if the S&P 500 jumps from 5,000 to 6,000, a traditional ETF like SPY would rise in value accordingly, but SPYI's returns would be constrained, prioritizing income over growth. Second, options income can be less predictable than stock dividends. While companies like Walmart or Coca-Cola have stable dividend policies, options premiums depend on market volatility, which can fluctuate. In low volatility periods, SPYI's yield could dip below 12%. Third, while NEOS aims for tax efficiency by classifying some distributions as return of capital, the tax treatment of options-based income can be complex. Consult a tax advisor to understand how SPYI's distributions will impact your specific situation, especially if you hold it in a taxable account. Finally, the 0.68% expense ratio is higher than passive ETFs, eating into returns over time. These trade-offs won't make SPYI a bad investment, but they mean it's not for everyone. Is it sustainable? So far, SPYI has delivered on its promise in the current market environment, where moderate volatility has supported its option strategy. The fund's $4 billion in assets and growing popularity suggest investor confidence. However, sustainability depends on market conditions. If volatility drops significantly, e.g. in a prolonged bull market, options premiums could shrink, potentially compressing SPYI's yield. Conversely, in a bear market, the strategy could still generate income, but the underlying S&P 500 holdings might decline in value. SPYI isn't a set-it-and-forget-it investment like a traditional index fund. Investors should monitor market conditions, the fund's monthly distributions, and its performance relative to the S&P 500. For example, in 2023, SPYI maintained its high yield even during market dips, thanks to elevated volatility, but a 2026 market surge could test its ability to keep up that 12% payout. Staying informed and reviewing your holdings quarterly is key to ensuring SPYI aligns with your goals. Who is this for? So, who is SPYI best suited for? If you're an income-focused investor seeking high monthly cash flow, perhaps to cover expenses like rent, utilities, or even a car payment, SPYI could be a game changer. Its 12.2% yield means a $10,000 investment generates about $1,220 annually, or $101.67 monthly, far more than a $10,000 investment in SCHD, $350 per year, or VYM, $310 per year. It's also appealing for investors comfortable with moderate equity risk and the trade-off of capped upside. Retirees, side hustlers, or anyone prioritizing passive income might find SPYI's monthly payouts transformative. However, if your goal is pure capital appreciation, e.g. maximizing growth for retirement in 20 years, or you're highly risk-averse, A traditional S&P 500 ETF like VOO or a dividend growth fund like SCHD might be a better fit. SPYI shines in portfolios that balance income and growth, perhaps alongside lower-yield, growth-focused ETFs. When I added SPYI to my portfolio, I allocated 20% of my income investments to it, keeping 80% in SCHD and VYM for stability. This mix gave me high income without overexposing me to options risk. What's your take on SPYI? Would you add a 12% yield ETF like SPYI to your portfolio for its juicy monthly payouts? Or do you prefer the slow and steady growth of classic dividend ETFs like SCHD or VYM? Drop your thoughts in the comments below. I'd love to hear your strategy. Are you bullish or bearish on SPYI's high-income approach? Let us know why in the comments section. If this deep dive into SPYI sparks some ideas for your portfolio, hit that like button to let me know. Subscribe for more videos on high-income strategies, stock analysis, and building wealth, and check out my other content on ETFs, tech, and investing. Always do your own research before investing. SPYI's yield is tempting, but make sure it fits your goals and risk tolerance. Thanks for watching, and let's keep growing our portfolios together.